Okay, so next up is our accounts receivable turnover. Accounts receivable turnover ratio is defined to be accounts receivable measured at the end of a period divided by sales made on credit. Now, one thing some of you may notice is that we have never segregated out sales, cash sales from sales made on credit. And certainly in the financial statements, these things are not segregated and unavailable to folks who only can see the financial statements and are not working inside a company. So usually the accounts receivable turnover ratio is approximated by accounts receivable at the end of the period divided by sales. And what this, of course, implies is the ratio is going to be useful for companies with most of their sales made on credit, right? Okay, so that's not going to be so good for the lemonade stand that has all cash sales, okay? But it is going to be good for things like Cal and Love, where most customers do pay with a credit card or something like that. Okay, so what it's measuring is how much of the entity's sales, credit sales really, in a given period are uncollected at the end of the period. So if we think about this a little bit, do we want to have big accounts receivable? In general, no. General rule in finance is that, let me write this down for us. In general, I've mentioned this before, but it's worth saying again. We want to get our cash, get incoming cash as soon as possible, and send out cash payments as late as possible within reason. And we'll see what within reason means in just a bit. Okay, so given that general rule, in general, it's always better to get cash that's coming in as soon as possible, and we'll see why when we look at the time value of money, which we're going to do very soon. And we want to send out our cash payments as late as possible. And again, when we get into the theory of the time value of money, we'll be able to formalize this a bit better. So back to the accounts receivable turnover ratio, folks would usually talk about it in this kind of context. At the end of quarter three, our accounts receivable is running at 27% of annualized sales, or at end of quarter three, our accounts receivable turnover is 0.27 years. Some folks will also want to use days instead of years. Very easy to do. We just change our units from years to days by multiplying by 365. Okay. Accounts payable turnover is sort of a corollary to accounts receivable turnover, and it measures our accounts payable at the end of a period divided by our purchases of inventory in the period. Now, once again, if we think about it for a bit, we'll realize that nowhere in any financial statement that we've seen or produced have we seen inventory purchases. So once again, folks that are analyzing the company from the outside, i.e. folks that only have access to the financial statements, are not going to be able to see inventory purchases. So this inventory purchases is very often approximated by cost of goods sold in this ratio. Okay, and the approximation again here is needed because inventory purchases not visible to outsiders. And we're sort of assuming with most of these ratio analyses that we're an outsider working at a hedge fund or a mutual fund or something like that, thinking about investing in a company, or at JP Morgan Chase as a loan officer, thinking about whether we want to make a loan to this company. In all cases, we'd be outsiders. Okay, so why is cost of goods sold a reasonable approximation to inventory purchases? Well, it's not always, but let's see how I get to this approximation, and then think about when it's going to be a good approximation and when it's not. Okay, let's start with this roll forward equation. Again, a roll forward equation is an equation involving accounting quantities that starts at the beginning of a period and gets us to the end of a period for that same quantity of interest. So in this case, this is a good one to memorize, by the way, or to write down on your cheat sheets. What's our inventory at the end of any period? Well, it's going to be the inventory we had at the beginning of the period, plus any purchases that we make, minus any cost of goods sold, right? Anything that's been matched to a sale and is gone. And this, of course, assumes no write-downs in the period, okay? So now let's get purchases of inventory on the left-hand side of the equal sign and everything else on the right-hand side. And here I can say that inventory at the end of the period minus inventory at the beginning of the period is delta I, change in inventory in the period. And for large steady state companies, the change in their inventory is not going to be so large. Let me just put in here, true for large steady state companies. Okay, so let's think of Walmart. Walmart's essentially growing between 0 and with GDP these days. They need to keep their stores stocked to the same level at all time. So pretty much as things are going out of inventory through COGS, the same amount of stuff is coming in through new purchases, or maybe with very slow growth. You know, what's our GDP? 2% a year. At best, Walmart's growing at about 2% a year right now. So a reasonable first order approximation change in inventory is 0. So if we make that move and we say that delta inventory goes to 0, then we're left with purchases of inventory similar to COGS. So now let's think about this a little bit and say, okay, so this is going to be true for large steady state companies, this approximation, but when is this not going to be good? How about very quickly growing companies, right, where their inventory is growing to keep up with their growing sales? Okay. And this goes again to the general point that there is no one perfect set of ratios for all companies. I said it before with relation to different industries and sectors, and now we have to say it again with regard to company size and growth rate. So some ratios that work very well for rapidly growing companies won't work as well for companies that are steady state and vice versa. Okay. All right. So that's our accounts payable turnover ratio. And what is our approximation? What can we say about this accounts payable end of period divided by COGS? How can we think of this? Well, it's really letting us know how much of a period's inventory purchases are unpaid at the end of the period. Now remember, using our general rule that we want to let cash should be dispersed as slowly as possible. In that case, looking at this ratio, bigger is better, right? In other words, we want to have a big pile of stuff we haven't paid yet that we're going to pay later, because that implies that we are letting the cash out the door as slowly as possible. I say reasonably possible because imagine that you are we could go back to Vermont Apple Company, and you buy a lot of fertilizer and you put it on account, and if you don't pay that for 3-4 months, the Agway store that sold it to you, they have to pay their employees, they have to pay their wholesaler of that fertilizer. You're putting them in a bind, and they're not going to like it, and they're going to stop doing business with you. So you can pay slowly up to a point, but you have to keep your suppliers happy, and it's good business to keep them happy. So you don't want to get too crazy with this. Okay, so what are our units and utilization here? Percent or years? People say things like 25% of our annualized inventory purchases are unpaid, or our accounts payable turnover is a quarter of a year. Some folks like to say days, so they'd just multiply by 365, and they'd say our accounts payable turnover is 70 days, for example. Okay. We have our usual annualization caveat there. And the last of this class of ratio is going to be the cash level. And the cash level is defined to be cash plus cash equivalents at the end of the period divided by sales in the period. And it's measuring what percent of our sales we're holding in cash. And this is going to be helpful for comparing different companies in an industry, because in general, we want to be as cash efficient as possible without running out of cash. Okay, so that means we don't want to keep too much cash just sitting around generating. That cash is an asset, and if we leave it sitting around, what's it going to generate? It's going to generate these days less than 0.5% in interest. So that's a pretty inefficient use of that asset. But on the other hand, we want to have enough cash sitting around so that if something untoward happens, we have a cash cushion and we can deal with it. Okay, just heads up, typical cash levels needed for safe running of a business. For a manufacturing company, minimum safe cash level 0% to 3%. This could be actually 0% because the company could take out what's called a revolving loan, which is essentially works like a credit card. So if a company like Walmart gets a revolving loan for $1 billion with Chase Manhattan, they get a special set of checks that goes with that loan. And if they want to pay a supplier from that loan, they use that checkbook, let's say for $1 million, and then the loan amount that they own Chase would automatically go up when that check was cashed by $1 million. So a company like Walmart that has a lot of inventory, has a lot of PPE, that sort of thing, they can actually let their cash go very, 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 very low, even to zero, if they have a revolving loan that they can dip into at any time to generate cash when they need it. For a technology company, minimum safe cash level 3% to 20%, depending on how young, rapidly growing they are. And for any startup, you want to have a lot of cash on hand, 20% to 200%. Okay. All right. So now, finally, we've gotten through all of our turnover and efficiency ratios, and let's look at Cal versus Love and do some analysis of them using these ratios. First thing we want to know, on average, who gets the most sales from their assets? Does this make sense? All right. And I want to point out again, during the past year, on average, okay, so that's going to imply TTM. Okay, so we're going to be looking at TTM for the first question here. Okay, and consistently true for the past 2 years, we're going to have to look at more than that. So who gets the most sales from their assets? Which ratio do we want? I don't know. I just learned all these ratios. So what we want to do is look at the ratio that has assets and sales in it, and we find that happily right at the top. That's our asset efficiency ratio. And the first thing we're going to want to look at here is just the TTM. And we have sales in the numerator, assets in the denominator, bigger is better. So Continental, okay, generates more sales per dollar of assets than Love does, okay. So we want to say here, we want to say Cal, and does this make sense? I'm going to just go ahead. This would be maybe an unfair question, maybe not, to ask on an exam. I'm going to say, yes, it does make sense. Cal full service, it's a full service airline, which implies first class fares. And everything that goes along with that, right? Southwest just has those economy cattle car fares. Has this been consistently true for the past 2 years? Well, here, Continental better, Continental better, Continental better, Continental better, better. So we want to say yes. Okay. All right, from comparing each of those quarters ratios. On average, who gets the most income from their assets? So this is going to be net income in the period divided by assets at the beginning of the period, or commonly what we've been calling ROA. Okay, here it is. Happens to be the next one down. And look at this result, though. This is kind of interesting. even though Continental gets more sales on average during the past year from its asset, Southwest gets more net income. Okay, net income over sales 4.23% for Southwest, 1.01% for Cal. Okay, so the answer to this is going to be Southwest or Love, ticker symbol Love. And how do we explain this given our answer to one above? Well, what's the difference between these two? This is the top line of the income statement, sales. This is the bottom line, it's sales. What's the bottom line net income? It's sales minus all the expenses, okay? So that must mean that Continental has higher expenses relative to Southwest. That's the only possible explanation. Okay, so Cal has higher expenses relative to its sales than Love. So we would say Cal has a higher cost structure. All right, so far so good here. On average, who provides owners with the best returns? How do you reconcile this with each company's ROA performance? So what's important here, part of the issue with this ratio analysis is to figure out which ratio to look at to answer a given question. So here we've got owners and returns. Okay, so we don't want something like ROA because ROA talks about net income over assets, and those are funded by everybody. So let's go back and see if we can pick out the right ratio for this case. We want returns for owners. How about net income, which would be returns for who are the owners? The shareholders. Okay, so I think return on equity is going to be what we want here to look at. All right. And again, we're looking at on average during the past year. So we look at TTM, and clearly we have on a TTM basis, we have Continental, okay, winning. So let's go ahead and put that in. This is all during the past year, by the way. So we've got here, let me just get the typewriter for Cal. How do we reconcile this with each company's ROA performance? That's a complicated question. I would prefer to defer till later. So I'm going to just cross that out. On average, who manages their receivables best? Okay. So we're going to have to find a ratio with receivables in it, and I'm only seeing one here. Okay, so that's going to be our accounts receivable turnover ratio, right? Okay, and now we got to go back to, is bigger better, is smaller better? In this case, smaller is better, right? The more AR we have, accounts receivable we have, that's the less cash we brought in. We want to bring in as much as possible. So who's doing better? 4.3 smaller than 4.9. So Southwest is doing better, and that's going to be from the AR turnover ratio. So that's going to be from the accounts receivable turnover ratio. Has this been consistently true for the past 2 years? Same thing, we just compare. Smaller, 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 smaller. So we can say yes. Okay. On average, who manages their payables best? So that's going to be the accounts payable turnover ratio, and which happily is right here. Okay, now accounts payable, remember, bigger, better for that. So whoever has the bigger ratio is going to be better, and that's Southwest. So we'll say love here. And I'm going to go ahead and cross out this question because you get the idea for how we're checking consistency for past 2 years by now. Assuming no impending mergers, etc., who has managed cash best and why? What inside information from Love might change your opinion? This would be this would be really not fair to ask on the exam because you don't really have enough experience yet, but I want to answer it anyway because it's kind of interesting. Okay, so we'd want to look at the cash level to see who's managing their cash best. And I'm here to tell you that based on my experience, we've seen as we've gone through this that in a lot of ways, Continental is shakier than Southwest. It's probably prudent for Continental to have a nice pile of cash on hand, which they do with this 23% cash level ratio. Southwest, and again, we haven't completed the analysis and you don't have enough experience to know this, so I don't think it's a fair question to ask of you all. It's more sort of an MBA student type question after they've already had a course in corporate finance. But Southwest has a 56% cash level ratio. That's very, very high, and as we're going to see when we go forward with this analysis, overall Southwest is in very, very healthy shape. So I would have to say that Continental is managing their cash best because they have a prudent level, but they don't have too much. And Southwest is doing so well. They've got all this cash kicking around that is earning at this time probably 1 or 2% a year, and that's a inefficient use of that asset, of that cash asset. They should be buying more planes with that or something else, right, where they can earn more money from the asset they exchange their cash for. All right, so let's go back and answer this. Who has managed cash best? So I'm just going to go ahead and say Cal, and I'm just going to say best cash level ratio. Again, not a fair question to ask you all. What inside information from Love might change your opinion? Well, Love is a healthy company. It's piling up huge amounts of cash. What if someone at Love said to you, hey, we're thinking about buying JetBlue? Well, this is probably an awesome time to buy another airline, right? Everybody's stock is depressed. Everyone's thinking the world is going to end. So if you're healthy and strong and you have cash to spare in your industry, this is when you want to buy other companies. Because why? Because they're cheap. They're on sale. So that might be some good information. So what inside information from Love might change your opinion? Something like they are considering buying JetBlue or another airline. I just say JetBlue rather than Continental because JetBlue is also not a legacy airline. I think it would be very difficult for one of the new wave airlines to buy a legacy airline and make that work. Okay, so let's leave that there. And the next thing up is a very interesting example of how the Justice Department used cash level and ROE to help bolster their antitrust case against Microsoft many years ago. So to get there, first of all, let's think about what makes an antitrust violator. Well, in the U.S., you have to be a monopoly to be an antitrust violator, but just because you're a monopoly is not sufficient for you to be an antitrust violator. So you can legally be a monopolist in this country, which is kind of interesting. But to be an antitrust violator, you need to be a monopoly and to use it to protect and extend yourself and to undermine consumer or customer choice. Okay, that's kind of interesting. Okay, so now let's go to the Microsoft example with that knowledge in our back pocket here. So in all the way back, showing what a fossil I am, going back to 1997, at that time, Microsoft required PC manufacturers to take their Internet Explorer, Internet browser, in order to get Windows 95, which was the latest version of their Windows operating system at the time. And by the way, at the time, PCs were everywhere, very dominant, very, very, very few folks had Apple PCs. So Windows-based PCs were everywhere. Everyone wanted Windows, and of course they wanted the latest version of the operating system. And there were, back at this time, other companies that sold internet browsers. Internet browsers weren't given away for free like Chrome and Safari and Firefox are these days. They were sold as programs, okay, just like a word processing program or a spreadsheet program. All right, so clearly only Microsoft could offer the purchasers of Windows 95, which were companies like Dell and Hewlett-Packard, anybody making PCs and selling them. The Microsoft's main competitor, Netscape, could clearly not do this because they're not selling Windows 95. Microsoft could do it because it had the monopoly on the operating system. So as a result, Netscape and others lobbied the Department of Justice to bring an antitrust suit against Microsoft, and they did. Okay, so let's think about this a little bit. In this case, if the DOJ proves that Microsoft is a monopoly, then requiring then the knowledge that Microsoft requires its customers to accept Internet Explorer is obviously an unfair use. Okay, so that would make the case work. All right. So what does Microsoft do here to defend itself? Okay, part of what it said was, hey, we're not a monopolist, right? They have to show that they're not a monopolist, otherwise they're totally screwed, right? We don't have a monopoly in PC operating systems. There's this operating system that runs on the same hardware, the same Dell machines, the same Hewlett-Packard machines from IBM. It's called OS2. I'm sure no one listening to this has heard of OS2. IBM sunk about $1 billion into developing OS2, and it was a spectacular flame-out failure. It lasted for about 2 quarters, and then they stopped selling it because it was really horrible, even compared to Windows, which was pretty crummy at the time, and no one bought it. So that's not really true. Maybe, maybe 1,000 users in all of you. So that's not really true. There was also at this time in a few computer science labs at Columbia, Stanford, MIT, Princeton, etc. There was the first version of the Unix operating system that ran on the PC hardware, the boxes sold by Dell and Hewlett-Packard and others. So there were maybe at this time something like 500 users in sophisticated computer labs. So there were other operating systems that ran on the same computers, but they weren't in anything like widespread use. Okay. So that's Microsoft Defense. How is the DOJ going to try and prove that Microsoft has an operating system monopoly? Well, one thing they can do is market share, and we've seen them countering here with the market share argument up above. So that's number one. And the other argument, which is very interesting, which was used in this case and has been used in others, is to look at their ROE. Okay, and that's what we're going to be looking at on the next slide. And before we get there, let's just let you know a couple things that again comes from experience that you will gain as you go on in finance and don't have yet. But in general, for large, fast-growing tech firms, at the time, these would have been firms like Oracle and Cisco, they're found empirically to have cash-to-sales ratios of about 3 to 10%, and ROEs of 15 to 25%. That's very, very healthy. Okay. So with that in our back pocket, the next thing we're going to do is look at these things, especially ROE for Microsoft. And we'll do that starting in just a minute.